Personal finance practice problem using OneNote. Loan payment calculation and amortization table. Prepare to get financially fit by practicing personal finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab. Down in the 1213 Loan Payment Calculation and Amortization Table tab. Also note, when using OneNote, look at the Immersive Reader tool. Our practice problems will also be in the text area. Same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, got the information up top, calculations on down below. We're looking at a loan payment type of calculation, which would be a standard thing that you might be looking up in a point in time where you have financing of anything such as a car or any other large purchase or even a home. You'd have the similar process to figure out what you estimate the payments are going to need to be. And then it's useful to do the amortization table, that giving you an idea of the breakout of interest and the principal. And it also gives you an idea of how much interest you're paying per year to consider whether there might be tax implications related to something like that as well. So we're going to assume we have the borrowings of $11,000. We're going to borrow $11,000. The interest rate is 5%. It's going to be repaid in yearly payments for 7 years. Now note, most of the time when we look at these kind of situations, these financing situations, they break it down to month-by-month financing when we're talking about normal financing for like equipment or a home or something like that. Loans can be paid off on a year-by-year basis. Typically, it's a month-by-month basis. The same concept would apply whether it's paid off monthly or yearly. We're going to start off with the years so that we can have a little bit more simplified of the calculation. And then we'll do monthly calculations in future presentations. Once you have the general concept down, then you can add that added little piece, which adds a little bit more complication to the calculations of the months. Note that when you look at months, then when you're looking at an amortization table, it's going to be a longer table that you're putting together, which would be difficult if done by hand, but not a problem when you do it basically in Excel. And we will work these problems in Excel as well. So we got how much are the payments. So the first calculation would be the payment calculation. First, let's think about this in terms of Excel functions. That's probably the way you would most commonly do it in a work type of setting. And then we can think about the same kind of concepts possibly using things like tables that you might do in a school setting. So if you were proficient with this, you'd probably say, okay, the payment calculation, there's a payment formula, and you can jump right down to the payment formula, which is kind of an alteration of the function that is a present value or future value formula. If you're not familiar with the payment formula and you have some idea of the present and future value calculations, you might first start off with a present value or future value calculation and then start to type in your known amounts. And that can kind of jog your mind as to what you need to do and then decide whether or not you want to go to another function or to use something like goal-seek to figure this out. So let's first use the present value, which is probably the function that we would be most familiar with if we're just learning present and future value calculations, and then let that jog our mind. So we're going to say we have the present value calculation. If we did this in Excel, I'd put the negative to flip the sign, present value of the rate, which we're pulling from the table. We're saying, okay, that we know what the rate is. That looks good. Comma, the number of periods. The number of periods, we know that's going to be the 7, which we're pulling from the table indicated by the cell reference. And then comma, and then the payment amount. And then we say, okay, wait a sec. That's the thing that we don't know. We don't know what the payment is. And obviously then we can see in Excel, we have this thing that says PMT standing for the payment. And that will help us to look to see if Excel has another function, which it does, the payment function, which we can then jump down and say, let's see if they have a function called the payment function. But before we do, let's see if we can kind of back into this payment function by using a goal-seek feature, setting up another cell where we will put the payment in, and then we can refer to that particular cell and ask Excel to then adjust that cell to what it needs to be to get the present value to what it needs to be. And we can kind of back into this valuation using the present value formula. We know what the end result then should be of this calculation. If we use present value formula, it should be the 11,000, the amount of the loan. So we can imagine basically putting some number into this cell other than the actual answer, which is the 1,901, like 1,000 in here. And we'd have a result that would be different than the 11,000. And then we can ask Excel, would you please change this cell to whatever it needs to be in order for the end result to be what we know it should be, that of 11,000. And Excel can then kind of use the brute force work to get to the answer of the 1,901. Or, of course, we can then take a look at the payment function and say, hey, does Excel have a function of the payment function? And put that down here and say they do have a payment function. And so that would be, I'm going to say negative for the same reason, because if I don't put a negative in there somewhere, it'll flip the sign to a negative. And you could put the negative within the present value, but I like to just put it in front of the P when I can. And then I'm going to say brackets, the rate is going to be, once again, the 7% indicated from the cell reference, comma, number of periods. The periods is going to be 7. And then we're going to say comma, and the present value equals the loan amount of the $1,000. That then gets us right to that 1,901. When you work with like a finance person, this is usually the calculation that they'll get to, and they'll act like the only thing that matters is whether or not you can pay the loan amount on a monthly basis. But that's obviously not all that matters, because I'm also concerned with how high the interest is, because how much interest am I actually paying? How much are you charging me for the rent on the money? And I also want to know basically what that is possibly on a year-by-year basis, especially if there's going to be tax implications on it, so that I can possibly take into consideration tax implications. So for that, and I might want to need to record this on my books, which means I'm going to need an amortization table breaking out the interest and the principal amount. So for that, you're going to say, hey, let me go ahead and plug this into my amortization table. And note also that it's quite useful if you're thinking about a big purchase like a car or some kind of equipment or a home or something like that, to be able to do this kind of calculation at your home, so that you're going in knowing what's going on, right? If you're talking to a salesperson that's going to be calculating this for you in front of you with a lot of pressure on you, then that's not where you want to be. Right? You want to have already kind of run these numbers in your mind, have an idea of it when you go in, and then be able to make your decision not under pressure by a salesperson, you know? So in any case, then you want to make your table. Now that I know the payment, I can make my table down here. Notice that if you're making amortization tables, the headers are usually the things that are going to be kind of difficult to do by scratch once you already have, or from the start without anything else. Once you have like a template down, or you know what the headers are, you can populate them quite easily. They are long, so if you had to do them by hand, that would be difficult. But with Excel, they're pretty easy to do. Test questions will often ask you to calculate the first and second period of this kind of table format. If you're in a school setting, they obviously can't make you calculate the whole thing if you're gonna do a long thing in like a test situation. So let's go ahead and do this. We're going to say now we got the periods from 0 to 7 periods. And we're going to say that the starting point is going to be our balance all the way to the right of the 11,000. So there's our 11,000 balance. That's our loan. And we know what the payment is. This payment is about, there could be rounding involved here, but that payment is simply being drawn from our payment calculation. You could calculate it within the table here if you choose to do that, but that's going to be done with our payment calculation. Then we can calculate the interest, which is going to be on a period by period basis, which is the 11,000 times, what did we say it was, 5%, times 5%, 0.05, 550 per year. If this was a month by month payment, then we'd have to divide that by 12, and that's where it gets a little confusing. And we'd also have to basically alter this rate to be a monthly rate and the number of periods to make sure that those are monthly periods. We'll talk about that in a future presentation. That means the loan decrease is going to be the 1,901 minus the 550. So we've got the 1,351. So in other words, we're making this payment. Part of it goes to what I would call like rent on the money that we borrowed, similar to rent say, an apartment building or something like that, that the rent just goes away. You're just using it to borrow, the use of the apartment, or in this case, the borrow of the purchasing power. It's not going to be decreasing the loan balance, which was actually used to purchase whatever it is we're purchasing, like a car or something like that. So we're then going to have the 1901 that we're paying minus kind of like the rent that we're not getting back. It's not going to decrease the loan balance. Means that the loan balance is going to decrease by 1,351 about. So then if we take our prior loan balance, 11,000, minus the 1,351, we then have our new loan balance of the 9,649. Now note that the payments are all even. That's the point, because when you're on a financing, you can see on both sides, it's kind of beneficial when you're dealing with individual loans that, you can set up the loan any way you want, but it's often easiest to say, I'm going to make the payments fixed, because that's going to make it easy for budgeting and to kind of verify that the people paying can basically make the payment on a standard basis. But the complicated thing about that is that the interest and the loan decrease will change from section to section, and that also makes it confusing when you're dealing with what a loan should be, or trying to argue about what the loan terms should be in real time without having to actually sit down and think about this, because it matters more than just simply whether you can make the payment or not. Because really the rent on the money is where they're going to try to increase your fees and whatnot. So in any case, then we're going to take this new balance of 9,649 times 0.05. That gives us our 482. And so now we're paying the 1901 minus the 482. That means that we're going to have a loan decrease of the 1,419. So the interest is going down over the life of the loan, and the amount of decrease in the loan is going up because the payment is remaining the same. So that means we have the 9,649 minus the 1,419 gets us to the 8,230. The payment, once again, is going to remain the same, and then we're going to have a change in the loan interest. So we got the 8,230 times 0.05 is going to give us then the 412 about. So the decrease in the loan will then be the same payment, 1901 minus the 412. That gives us the 1489 about. The prior balance was 8230 minus the loan decrease 1498 gives us about the 6741. Taking that times the 0.05, we got the same payment. Interest now is going down to 337. We can then take the 1901 minus the 337, means the decrease in the principal will be at the 1564. And then we had the prior balance, the 6741 minus the 1564 is going to give us the new loan balance of the 5177. We, of course, can continue on with this process. And if you set up your table properly, then you'll see the ending balance here should be at 0 at the end of the loan term, because that means you've paid the entire thing off at that point in time. If something went wrong and you copy this down in Excel, that 0 will not be 0, and that usually indicates that you have a problem somewhere. Also note that the interest decreases as the loan goes forward. That's the cost, the confusing cost of us keeping the payment the same. That can be important because we want to know how much interest we're paying, because we want to make sure that we're paying an appropriate amount of interest, which is kind of like the rent on the loan. And also there could be tax implications with regards to it, meaning oftentimes the interest is something that's deductible and the loan decrease is not the deductible kind of portion of this whole thing. So you got to take that into consideration if you're looking at taxes, especially with like a home loan, or if it's some kind of business loan where you get to deduct the interest related to that. Now you could use tables to do this as well. And we're actually looking for the payment here. So when you look at the tables, it's a little bit confusing, but a school question might do this. They might force you to use the tables in kind of a strange way, such as this. So the way you'd want to think about it, if they take your calculator away and they say, solve this problem by using tables, by backing into the payment amount, this 1,901, Well, you could say, okay, usually I use the tables by taking the payment times the amount from the table to get to the present value of this 11,000. You can rework this algebraically, but I like to just keep it in this small calculation in my mind when it's only like 3 numbers. And then this end number, I know the end number now. So I'm going to say, okay, that 11,000, that should be this. I know the amount from the table. So that means I can, of course, back into the payment by using the tables. So this is an unusual, unconventional kind of way of using the table, fairly unconventional. But, it's definitely something that might happen in a test situation if they take away Excel and your calculator and force you to back in to this payment using tables. So we can look up on the tables. We can say that's going to be 5%, 7 years, 5 and 7, 5 and 7 is going to give us the 5.7864. So there's the 5.7864. So if the 1901 or whatever this cell, if I didn't know what it is, times this equals 11,000, that means that the 11,000 divided by the 5.7864 has got to equal the top number, which is about 1901. And then, of course, you can double check it. You can rework it algebraically if you want to solve for the yellow number or whatever. But you can then check it. 1901 times the 5.7864 then gets us to about the 11,000.